The trading floor goes silent at 2:47 a.m. Eastern. Not the usual pre-market quiet. Something else, the kind of silence that arrives when a number appears on a screen that shouldn't exist. Beijing has just placed sell orders for $916 billion in US Treasury securities, all at once. No warning, no announcement. Just executed through a coordinated array of intermediaries across Hong Kong, Singapore, and London. The algorithms pick it up first, then the humans start making calls. By 3:15 a.m., 14 people in 3 countries know what's happening. By 4 a.m., that number is 200. By the opening bell, the information will have metastasized beyond control. But right now, in these narrow minutes before dawn, there's still a strange kind of order. The machinery hasn't broken yet. It's just starting to overheat. In this simulation, we're examining what happens when the second largest holder of U.S. debt executes a liquidation event of unprecedented scale. Not gradually, not telegraphed through diplomatic channels, just done. The assumptions are simple. China's foreign exchange reserves have been quietly reorganized over 18 months. Alternative currency arrangements with Russia, Saudi Arabia, and Brazil are already operational. The decision has been made. The execution is underway. History gives us fragments of this pattern. In 1992, George Soros broke the Bank of England by betting against the pound. The British government burned through billions trying to defend an exchange rate it couldn't sustain. It failed in hours. In 2008, Lehman Brothers collapsed, not because it ran out of money, but because everyone simultaneously realized the money they thought was there never existed in the form they needed it. Liquidity is a collective hallucination. It persists until it doesn't. The mechanism unfolding now is different in scale, but familiar in structure. US Treasury bonds are considered the safest asset on Earth. They're not just investments, they're the foundation. Banks hold them as reserves. Pension funds build portfolios around them. Central banks worldwide use them as collateral. The entire architecture of global finance assumes they're stable, liquid, unshakable. When China starts selling, the first effect is mechanical. Bond prices drop, that means yields rise. The 10-year Treasury yield, which opened yesterday at 4.2%, hits 4.9% by 6:00 a.m. By 9:00 a.m., it's at 5.7%. These movements would normally take months. They're happening in hours. The Federal Reserve sees it immediately. Emergency calls begin before sunrise. The New York Fed, the Treasury Department, the White House is briefed at 5:30 a.m. The language in these early calls is careful, controlled. But underneath, there's a recognition that the playbook doesn't have a page for this. The Fed can buy treasuries to stabilize prices. That's called quantitative easing. They did it in 2008. They did it in 2020. But buying $1 trillion in a single day means printing $1 trillion in a single day. It means admitting that the stability everyone believed in was always conditional. By 7 a.m., the decision is made. The Fed will intervene, but intervention at this scale creates its own problems. Every dollar printed dilutes every dollar already in existence. The currency weakens. Imports become more expensive. Inflation, which had finally started to calm, gets a new fuel source. Markets open at 9:30 a.m. The Dow drops 400 points in the first 11 minutes. The S&P follows. NASDAQ goes into free fall. These aren't retail investors panicking. This is institutional. Hedge funds, sovereign wealth funds, pension managers. They're watching Treasury yields spike and recalculating everything. If bonds aren't safe, nothing is. If the Fed is printing money at emergency scale, the dollar isn't stable. And if the dollar isn't stable, every portfolio on Earth needs repricing. Currency markets move next. The dollar index, which measures the dollar against a basket of other currencies, drops 3% by 10 a.m. That's a massive single-day move. In Forex terms, it's an earthquake. The euro strengthens. The yen strengthens. Gold, that ancient refuge, jumps 8% in 90 minutes. But the real damage is happening in places most people never see. The repo market. This is where banks and financial institutions borrow money overnight using treasuries as collateral. It's a multi-trillion-dollar daily operation that keeps the whole system liquid. When treasury values become unstable, the repo market freezes. Banks stop lending to each other, not because they don't have money, but because they don't trust the collateral. In 2008, this freeze is what turned a housing crisis into a global meltdown. By noon, 3 mid-sized regional banks have quietly reached out to the Fed for emergency liquidity. They're not insolvent, not yet, but their depositors are starting to move money. Wire transfers out, ACH requests pending. The banks have the funds, technically. But if everyone asks for their money at once, liquidity becomes a timing problem. And timing problems in banking become solvency problems very quickly. The first visible cracks appear in payment systems around 1 p.m. Venmo transactions start taking longer to settle. Zelle transfers hang in pending status. It's not an outage, it's congestion. Millions of people are moving money simultaneously, trying to get to whatever feels safer. Checking to savings, savings to money market funds, dollars to crypto, crypto to stablecoins. The infrastructure can handle normal flow. This isn't normal flow. ATMs in major cities start running low by mid-afternoon. Not everywhere, not all at once, but in enough locations that local news starts noticing. A branch in downtown Chicago, 3 machines in Brooklyn, 4 in Los Angeles. The banks have cash reserves, but cash doesn't teleport. It requires armored transport, scheduling, coordination. When demand spikes unexpectedly, the system lags. Gas stations begin seeing unusual activity around 3 p.m. Not panic buying yet, but people topping off tanks who wouldn't normally. The psychology is subtle. If money might be weird tomorrow, spending it on tangible goods today makes sense. Fuel, groceries, batteries, nothing dramatic. Just a shift in behavior that, multiplied across millions, creates pressure. Grocery stores notice it too. Bottled water moves faster, canned goods, rice, pasta. The managers don't understand why. There's been no announcement, no official warning, but information moves through social networks faster than news networks. A tweet with 40,000 retweets. A TikTok video explaining what's happening in 2 minutes. A Reddit thread growing by hundreds of comments per hour. People aren't panicking, they're hedging. By evening, the Fed issues a statement, carefully worded, reassuring. They're monitoring the situation. The banking system is sound, deposit insurance is secure. Treasury markets remain liquid. It's all technically true. But the need to say it makes it less believable. International markets react overnight. Asian markets open to chaos. The Shanghai Composite surges. The yuan strengthens sharply against the dollar. Japan's Nikkei drops 4%. South Korea's Kospi follows. In Europe, the DAX and FTSE open down 3%. The European Central Bank issues its own statement. Coordinated language. Same reassurance. Same underlying tension. By the morning of day 2, the narrative has shifted. This isn't just a market event. It's geopolitical. Cable news cycles into overdrive. Analysts speculate on motives. Retaliation for tariffs. Preparation for Taiwan. Leverage in some larger negotiation. The speculation doesn't matter. The effect is unfolding regardless of intent. What becomes clear is which institutions were built to withstand this and which weren't. The largest banks, the ones deemed systemically important, have liquidity buffers. They've been stress tested since 2008. They're weathering this, barely. But smaller banks, regional lenders, credit unions, they're fragile. Their balance sheets are loaded with treasuries that just lost value. Their depositors are nervous. Their access to emergency funding is slower. One regional bank in the Midwest doesn't open on day 2. A brief statement cites technical issues. By noon, regulators have quietly taken control. It's not called a collapse. It's called a resolution. The depositors are protected, technically, but the message spreads instantly. If one bank can close, others can too. Lines form at branches in 5 states by early afternoon. Not long lines, not desperate crowds, just more people than usual wanting to see their money, wanting to touch it. The psychology of banking depends on everyone not doing this at the same time. When enough people do, even strong banks feel pressure. Credit card payment systems start showing strain, not failures, just slowdowns. Authorizations taking longer. Some transactions decline that shouldn't be. The payment networks, Visa and MasterCard, run on interconnected global infrastructure. When banks become uncertain about each other's liquidity, the authorizations get more conservative. Spending limits drop. Approvals require secondary checks. By the evening of day 2, the stock market has lost 11% over 2 sessions. Retirement accounts have collectively shed $3 trillion in value. Most of that is paper losses. It only becomes real if people sell. But the psychological effect is immediate. Wealth feels more conditional. Plans feel more uncertain. Internationally, countries are making calculations. Do they hold dollars or diversify? Do they defend their own currencies or let them adjust? Do they align with the US response or stay neutral? These decisions take time, but the discussions are starting. Alliances are being stress tested in real time. The Fed announces a second intervention, another round of bond purchases, another expansion of the balance sheet. The dollar drops further. Inflation expectations rise. The 10-year yield stabilizes, barely, at 6.3%. That's the highest it's been in 23 years. Mortgage rates, which track Treasury yields, are now approaching 9%. The housing market, already cooling, begins to freeze. Buyers disappear. Sellers hold. Transactions stop. What becomes visible now is the difference between the system holding and the system functioning. Banks are still open. Payments still process. The infrastructure hasn't collapsed, but it's operating under strain, slower, more expensive, less reliable, and that changes behavior. Businesses start hoarding cash, not investing, not expanding, just holding liquidity in case access becomes restricted. Employees notice, hiring slows, projects pause, the economy doesn't crash, it contracts, quietly, gradually, then faster. The irreversible part isn't the initial shock. Markets can recover from shocks. The irreversible part is the loss of trust. Once people realize that safety is conditional, that liquidity can vanish, that the institutions they relied on are fragile, behavior changes permanently. Savings rates go up, spending goes down, risk tolerance disappears, some entities benefit. Gold dealers see unprecedented demand. Bitcoin, despite its volatility, becomes a refuge for some. Countries with commodity-backed currencies find leverage they didn't have before. But these are marginal wins in a larger destabilization. The haunting part is how fast normal becomes abnormal. 48 hours ago, the system felt permanent, stable, boring even. Now it feels conditional, temporary, held together by collective belief that's eroding in real time. History will call this a financial crisis. But that's not quite right. It's a trust crisis. And trust, once broken at scale, doesn't repair quickly. It might not repair at all. The cameras will keep rolling. The analysis will continue. But something has already changed. Something underneath. The foundation everyone assumed was solid turned out to be a consensus. And consensus, it turns out, is just another word for fragile. If you want to understand what happens next, you'll need to keep watching.